everything's going to be just fine. I'm not so sure that that's the case with one Jerome Hayden Powell. You wouldn't even need a Fed. The Fed would become completely irrelevant.
Hello, everybody. This is Doug Hill with Paradigm Press, and welcome back to the Paradigm Press YouTube channel. And we're glad you're here today because we have a very timely interview lined up for you. And if you're like most people, you're probably concerned about rising prices throughout the economy, the government piling up debt at the fastest pace in history, and layoffs, as well as the risk of a recession. And if that's true, you're in the right place, because today our guest, Danielle DiMartino Booth, is a former Fed insider, and she spent 9 years at the Federal Reserve Bank of Dallas, serving as an advisor to then President Richard Fisher. She was literally in the room during 2008 housing crisis, giving her insights to the modern Fed that very few people know. She's also the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. Danielle's insights on the economy and the inner workings of the Federal Reserve itself are invaluable, especially in times like these. Danielle, welcome to the show.
Thank you for having me. And I look forward to speaking about living in really, really interesting times.
Well, that was a Chinese curse, right?
Exactly.
Yeah. Well, let's start with the elephant in the room. You know, the economic story of the last year and a half has been inflation and the Fed's response to the inflation here in the U.S. And you mentioned in a recent call, the lagging effects of rate hikes is about 12 to 18 months, meaning it takes about that long for a rate hike to work its way through the economy. We started raising rates in March of 2022. We're about 18 months from the very first rate hike. So you could argue that most of the rate hikes that the Fed has done over the last 18 months haven't even made their way through the economy yet. So what does that mean for the U.S. economy, and what does that mean for investors?
Well, I think first and foremost, people have to bear in mind that had it not been for a lot of the overreach, fiscally speaking, that we would have been feeling the lags sooner than we have. And I bring this up because it's a really critical nuance. What that means is, there's an old saying that payback is a you-know-what. And my greatest concern is that because the government has been spending so much money, a lot of people who have bought into this soft landing narrative are going to end up feeling like they've been sideswiped. They're like, whoa, we didn't think this was coming. The reason I bring it up from this angle is because if you look at a chart, for example, of construction spending, a lot of that reflects infrastructure money that's taken a long time to get out into the economy, the beginning of the CHIPS Act. At the same time, you have a stock jock's main leading indicator, ISM new orders. There are very few things that stock jocks, I call them stock jocks. It's not disparagingly. I'm just saying they follow a few varsity indicators. They follow non-farm payrolls at the headline. They follow the unemployment rate. They follow CPI, the consumer price index. And on the cyclical side of the economy, they follow ISM new orders, because they typically tell you where the economy is headed or where Wayne Gretzky's puck is going to land. They've been negative for 5 quarters in a row, not 5 months in a row, 5 quarters in a row. And yet, if you were to look at the headlines today with the unemployment rate south of 4%, you really wouldn't think that we would have seen that long of a run in recessionary territory. So that's why I worry about the lag effect of lags, because they're going to come and hit harder than most people realize.
So what you're saying is that the 12 to 18 months may be extended to 18 to 24 months because of the fiscal stimulus that the government's been putting into the economy. Is that right?
Yes. There's going to be an element of delay. And in addition to that, people forget that quantitative tightening is its own form of continued Federal Reserve monetary policy tightening. In other words, for every marginal amount of tightening that is undertaken by the Federal Reserve, whether it be in the form of interest rate hikes or shrinking the balance sheet, there is a brand new lag effect that follows. It's like when my 3-year-old was at the beach for the first time and he said, "Look, another wave is coming." A few minutes later, be like, "Look, it's another wave." My point is that for every incremental amount of tightening, there's going to be an incremental lag effect that follows behind that which has been building up since March of 2022.
So in your estimation, you're the founder of QI Research, and you speak to your readers every day or often enough to keep an eye on what's going on in the markets. What does that portend for U.S. stock investors?
So I think the thing to be wary of right now, especially right now, because you have so many talking heads who are being very reassuring about the price to earnings ratio coming down. But if you factor in what I've just described with future pressure and prolonged pressure on not just earnings, but on revenues, then it's really difficult to calculate the price to earnings ratio, because that earnings, we don't know where it's going to land.
Right.
So we can say that on a relative basis, compared to what it was, say, 12 months ago, that the price to earnings ratio is lower than it was. What we don't know is where earnings are going to land, and therefore how overpriced markets remain. And that's what gets to be very, very difficult, especially when we have been brainwashed. We have been trained to anticipate the Fed riding to the rescue for 2 cycles in a row now. We're going to the zero bound. The Fed's going to relaunch quantitative easing. Everything's going to be just fine. I'm not so sure that that's the case with one Jerome Hayden Powell.
We're going to dig into that because I think there's a lot of squirming going on, at least from the readers that I speak to on a regular basis, about the outside spending the government is doing and what that will mean ultimately as well. But just so that people watching know, I'm going to be talking with Danielle for the next half hour or so, and we're going to talk about predictions and forecasts for 2024 that Danielle sees as a result of everything that's happened this year, and give us what she sees happening in 2024. So stay attuned for that. Danielle, recently there was a CPI measure that came in a lot cooler, or at least cooler than expected. We have a CNBC quote that's up on the screen that says CPI unexpectedly misses across the board, core inflation lowest in over 2 years. That's CNBC. And the market, as a result, just took off. At some point, it was up 500 points on that day. So what does that tell you about investor sentiment? And what does that tell you about the stock market as a whole as it pertains to the Fed pivot?
So bad news is great. That's what we're hearing. Bad news is fabulous. It's going to force a pivot. It's going to bring about, sooner than we had originally anticipated, prior to inflation coming in, cooler than what was expected. It's going to force the hand of Jay Powell and require deeper rate cuts in 2024, earlier than we had anticipated. Sis boom ba go. That's the interpretation. And I would remind market historians, everyday investors, it doesn't take a lot to have to Google back to November, December of 2018, because it wasn't that long ago. And back then, what produced the Powell pivot wasn't any kind of upheaval in the stock market, which he's seeing the opposite of. Every time financial conditions loosen, by the way, and loosen is a way of saying every time stocks go up, Jay Powell's given more ammunition to stay the course and remain tight, if not get tighter. So people have to bear that in mind. But back in 2018, it was a seizing up in the credit markets. It was no high yield bonds being sold, and it was the credit mechanism feeding into the stock market. That's what prompted a pivot. It was the bloodbath of Christmas Eve 2018. We haven't seen anything like that. We haven't seen anything remotely resembling capitulation in the stock market. And that is why I think investors should be very careful about celebrating an imminent repositioning on the part of the Federal Reserve, an imminent pivot.
Yeah, I think what sometimes gets lost in these inflation numbers, and I was talking to Jim Rickards about this just the other day, and is that if inflation comes in, let's say 4%, let's just say 4% year over year, that's 4% over last year's number. And last year, inflation in that month might have been up 7, 8, 9%. Mm-hmm. And so the pain that people are feeling when they go to the grocery store, when they fill up their gas tank, when they get things delivered to their home, that pain is just because it's down from 7 to 4. While that's progress, that's not the end game here, right? You know, in order for prices to come down and middle income families to really feel relief from higher prices, you need inflation to go negative. You need a deflationary environment in order to get back to where we were 2 years ago or 5 years ago. What are your thoughts on that? And do you find that your readers and people in your circles kind of lose sight of that, or is that kind of a known quantity to them?
No. So I think the higher the net worth, the more immune you are to what you're describing, which is cumulative price pressures.
Right.
So it doesn't matter, let's say, that egg prices are no longer going up. What matters is that they're still incrementally much higher than they were in the fall of 2019, headed into that particular holiday season. That's what matters. And even more importantly, if you do get the deflation required to ease the cost of living crisis for households, that typically comes hand in hand with job losses and a rising unemployment rate. So it's your proverbial double-edged sword. Right. And that, I think, is one of the reasons that even though we've seen prices at the gas pump come down quite a bit, when you see these readings of consumer sentiment, they're actually reporting that inflation is more problematic than it was, say, 6 weeks ago. Even though the most visible form of inflation, the prices at the gas pump, even though those prices have come down, what does it mean if they're reporting that inflation's worse? That means their income's coming down. And that on a relative basis, they're still spending more than they have, which means that for discretionary purchases, and by the way, discretionary is where we're seeing actual deflation breakout, things that people want to buy as opposed to things that people have to buy, the essentials. That's where we're seeing outright price declines. And it's not a healthy sign for the broader economy going forward, because the last thing corporations, businesses want to see is falling pricing power, falling demand, which forces them to press on with the cycle of cutting costs, which is an elegant way of saying reducing headcount. That's why it's a cycle.
Well, there are some things in the news I want to touch on here in a little bit regarding layoffs, but you're being a Fed insider, I have to ask, look into your crystal ball. Is the Fed done raising rates?
So I think that one is going to be the easiest of all to respond to. I do think that the Fed is finished raising interest rates. The problem is, I don't think the Fed is ready to begin lowering interest rates. So you have a very stubborn backdrop, whether it is an office building or whether it's a corporate bond issue that has to be refinanced. If where you're talking about the cost of capital being a stubbornly high plateau versus where that was originally financed, if the divide between the two is a multiple of the former, then you have a huge problem on your hands, even if the Fed is done raising interest rates.
So the higher for longer is that tenet. You believe that that is going to be the case until something happens that forces the Fed's hand to loosen and lower interest rates. Is that an accurate statement?
I think that's a very accurate statement, and we have to bear in mind the bigger backdrop of kind of crossing the Rubicon into an election year, and the Fed traditionally not wanting to make any moves that have it appear that they're trying to sway the electorate one way or the other. So making changes to monetary policy in 2024, it becomes that much more difficult to do so because of that political aspect. And in the very few long form interviews that Jay Powell has given in recent years, especially, he will say up, down, and all around that he wants to make sure that the Fed remains independent. Mm-hmm. That means it's going to be much more difficult for all of the easing that markets have been celebrating actually coming to fruition next year.
So if we're in interest rates are going to be at this level for a while, an indeterminate amount of time, what industries are hurt most by lengthy higher interest rates?
So I think that there are some very easily identifiable industries: telecommunications, healthcare, being at the top of that list, consumer discretionary companies. They're kind of the first in the pecking order, many of them at least, are the first in the pecking order of companies who are going to run up against a so-called maturity wall in 2024. And that is an actual tick tock, boom, you must refinance your debt. You've got mail. To age myself about 30 years. But it is that moment for company treasurers, for chief financial officers, that they actually have to go to market. And there's no truer test than a company's health than that of its cash flow and whether it can service its debts.
Well, I want to talk to you about that and the regional banks and commercial real estate as an extension of that. But before we go there, I know you have some thoughts on that. But before you go there, I want to talk about the fiscal policy and the fiscal process that we're in right now. I'm just ran some numbers. We're $33 trillion in debt, which is 123% of GDP based on numbers I found this morning. And I'm going to read you a quote from Ken Griffin, right? He's a hedge fund manager, billionaire. I'm sure you know of him. And he's the majority owner of Citadel. And here's a quote. So he says, the U.S. is spending like a drunken sailor. Debt accumulation in Q3 alone was $1.01 trillion. $1 trillion raised in one quarter. And I say this just disbelief. I remember times, Danielle, when early 2000s, when people had to define what $1 trillion was. I mean, it wasn't even a number. I mean, tens of billions of dollars were big numbers back then. Now we're raising $1 trillion in debt. And the interest on our debt is approaching $1 trillion a year, which is twice as much as it was in 2022. So that fiscal picture just painted right there, and you can clear up any discrepancy there may be, but where does or how does this end?
So, I don't think that debt and deficits all of a sudden matter to the bond market. Now, let me be clear. That's different than saying I do think that Jay Powell has one more reason to stay the course of higher for longer. It was once the case that I was of the mind that for the first time in 40 years, private equity might actually have to mark to market instead of mark to target if Jay Powell could hold the line. But given the fact that we have one debt ceiling standoff and one, oh God, we're not going to be able to, and budgetary, all of the hemming and hawing, none of it's produced fiscal reform.
Right.
None of it. So I think that one of the beneficiaries of Jay Powell being higher for longer is the forcing of fiscal discipline on our nation's politicians. If you have to spend $1 trillion servicing your debt, by definition, you're going to have to become a little bit more circumspect about other spending. Now, why is it important today? Because to Griffin's analogy, since Reagan was in office, we've been spending like drunken sailors. Of course, when Reagan was in office, it wasn't 133%. It was 30% of debt to GDP. So obviously much different backdrop, but we've been spending more than we make. Had the United States been a U.S. corporation, long since would have gone into Chapter 7 liquidation. Forget Chapter 11. Mm-hmm. But at this point in time, higher for longer hurts more because we have a divided Congress. Yeah. And because even though you're talking about a $4 trillion per annum run rate of increasing debts, at the margin, there's not going to be legislation underwritten the way it was with the CARES Act or the 2 stimulus bills that followed. Because there's nothing that this GOP-led House of Representatives is going to do. They're not going to lift a pinky finger to try and make it easier for the incumbents on the other side of the aisle come election day, which is less than a year from now. So I think people have to be aware that the CHIPS Act or ESG or DEI, those types of spending, they don't act into the economy. They don't manifest in the economy the same way that stimulus spending does in the way that it was done after the pandemic, which is directly deposited into U.S. checking accounts. Right. Nor does it produce the inflation, mind you. And it's very feasible that after 2025, that the U.S. goes to hell in a handbasket and we're flirting with hyperinflation. If you get the critical mass to bring that kind of stimulus spending back again directly into the hands of Americans who are going to run out and spend it and drive inflation back up. But in between here and there, there's one heck of a hill to go up and get over. And I don't think that this House of Representatives is going to make it any easier going into the election season, nor is one Jay Powell.
Okay, that's interesting, and tying it all into how that plays into the election. I wonder, the people who are buying these bonds. Right now, we have bond issuance last, I think it was a few weeks ago. Is there a time where those people back off and they're like, you know what? I know that I'm going to buy this bond and the dollars that I'm going to get paid back in are going to be worth a fraction of what they're worth today because the U.S. has to print more money in order to service their debts. Does that time come? And when you're in the Dallas Fed, were discussions had about that? I know that was a while back and the situation's gotten a lot worse, but are those discussions being had at the Treasury and the Fed?
Well, I certainly think that the discussions are taking place for the moment, because you have generations of pension fund managers and individuals running life insurance companies that have not been, they haven't had the luxury of matching their liabilities to their assets for years. So, and U.S. households have also been crucified for being savers in recent years. So for the moment, I think that there is a deep enough pool of natural buyers. There was a very messy recent long bond auction. What people don't realize about that really messy long bond auction was that the actual sheer number of dollars purchased rose 14% from the prior month. It was by virtue of the fact that there was an even bigger bond sale at the time. But again, we had a 14% increase in natural buyers ponying up, billions and billions of dollars more of demand. So there is natural demand at our Treasury auctions. What is a lot more tenuous, though, I would say, is when you start to see some of the yields come down a lot and whether or not those are attractive in recession. And if I'm Joe Q, CIO, pension fund manager, if I don't just stick to the short end of the curve and potentially refuse to step in at the long end, if the yield on the long bond is cruising back towards 3% again.
Mm. And that's where you get the inversion.
Mm-hmm.
Is that correct? Yeah.
What few people like to talk about in polite company is that the yield curve did not magically uninvert. In fact, it got close to uninverting and then it retrenched back into inversion, reflecting the fact that even if we theoretically whipped inflation in a higher for longer environment, you still have a Fed refusing to take those short end rates down.
Right. So you and we spoke in May. I believe it was in May of this year. We went to Jekyll Island together, you and me in the Paradigm group, and Jim Rickards was there. And you said something, and I recalled it, and I wanted to ask you again this question today. So you said, and I apologize if you don't recall this. I don't want to feel like I'm ambushing you, but you said there's systemic risk. You feel it, but you don't know where it's coming from. Mm-hmm. Do you remember making that comment? And if so, have you gotten any clarity since then, or do you still feel like you're not sure where the systemic risk is coming from?
So, we're still not there in terms of being able to identify it. And it typically doesn't happen until it's staring you in the face. If anything, I think since May, because then we were still kind of feeling the Silicon Valley Bank fallout, and the banking crisis was very, very much, still recent at that point. And now it feels like it's really far away. Everything's fine, blah, blah, blah. Let's go on. And look, long rates are coming down. Banks hold maturity losses. They weren't what they once were. Life's going to be fine. Okay. What about WeWork? So I would venture to say, counterintuitively, that WeWork might prevent systemic risk because it's going to force transactions. Whereas prior to WeWork filing for Chapter 11, the modus operandi was at all costs, do not transact. Mm-hmm. No matter what you do, don't put a price on it. Because once you put a price on it, that's it. We've got price discovery. Once it's price discovery, all bets are off. So everybody extend and pretend and look the other way and look no evil, see no evil, hear no evil. But WeWork was like, all right, you don't want to renegotiate these leases out of bankruptcy? I call your bluff. Let's do them in bankruptcy and see how that works out. So if you end up propelling forward the commercial real estate cycle, before the issue is forced in 2024, because commercial real estate it goes underneath, if you will, corporate bonds. So if corporate bond pricing starts to kick out in 2024 because of refinancings being forced, that means that commercial real estate is going to become a subordinate deal. From the perspective of a bank and the space that they have on their balance sheet to provide financing, meaning corporate real estate financing costs gap out even more. But if WeWork is going to force bankers to work through the holidays, bless their hearts, then you might end up keeping price discovery going, despite the best intentions of the bankers who were hoping they would be able to wait until Jay Powell thank heavens, got the whole world back to the zero bound.
That's interesting, the price discovery component of that. It's like a neighbor of mine that sells his house because he has to, not because he wants to, and he puts it at a fire sale. And then all of a sudden, that's a comp for my house. Is that a realistic?
So I tweeted out I recently tweeted out every realtor's worst nightmare, biggest 4-letter word is comp.
Yeah.
That's exactly your point.
Yeah. Okay. Well, I think that makes a lot of sense, because if WeWork holds it on their books and they're saying, "Hey, we're holding these properties to maturity," we don't have to actually recognize what they're really worth. But when you go into bankruptcy, you do. So, well, let's talk about that, because I've been, Danielle, you're a fantastic follow on Twitter. I'm still going to call it Twitter. I'm not calling it X.
I'm not calling it. No, if I call it X, I get more XXX rated bots. So I'm happy to keep calling it Twitter. Thank you very much.
Okay. So you're a fantastic follow on Twitter. I've been thinking about the commercial real estate dilemma for our regional banks for a long time, for probably about 6 months, a long time for me. And I learned something in doing the research, and I'm going to share it here. And it may be known to a lot of people, certainly to you, but when a company buys a piece of property, a commercial real estate, they will have a 30-year amortization on the loan, but the loan is usually a 5 or a 7 or 10-year term. And so while if I buy my house, it's a 30-year term, a 30-year more, amortization, I just pay it for 30 years. But these guys have to re-up their loan paperwork every 5 or 7 or 10 years. And God help any of these companies that have paper that's due right now that they got in 2019 or 2018 when rates were very low, and have to re-up that. So their interest costs go through the roof, their payments go through the roof. At the same time, vacancies are down. So, I mean, I'm telling you, like, you don't know this, you know all this, but it's such how does that play out? Like, how do these banks stay solvent for so long when all this is happening under the cover, so to speak?
Well, I think that the moment of truth is going to be coming for many more banks going forward, because WeWork has forced the issue to the front. And the answer is, we don't know how this is going to end. We don't know what the final chapter looks like, and that's a scary proposition in and of itself. A lot of it has to do, and I don't mean to be kind of skirting the issue, but I think at this juncture in the commercial real estate cycle, if the FDIC had been able to broker more marriages by now, it would have.
Yeah.
But it's exceedingly difficult to have one bank buy another bank when any transaction between two banks is going to require purchasing losses. And it's one thing to just say, I'm going to buy that loan book for pennies on the dollar, because I'm the acquiring bank. It's a whole nother thing to acquire their treasury and mortgage-backed securities portfolio and take those losses on. Yeah. And so that is the complicating factor, I think, in the current episode, is that we would be seeing a lot more FDIC brokered bank mergers than what we're seeing. So what you don't want to have is you wake up one day and you're like, oh, the bank's in receivership. There it goes. Yeah. And if you've been following the saga at Signature Bank, the assets just keep going back to the drawing board because the FDIC can't find a buyer. So it's a very, very, the price that we pay for the amount of debt that was added on and the extending and pretending that was done after the pandemic is a gigantic unknown. But it was a price that was undertaken with eyes wide open while this huge battle was fought in Washington, D.C. between politicos trying to figure out whether or not it should be Lael Brainerd or Jay Powell. Right. It was a very costly 6-month battle that was eventually won by Jay Powell. But for a lot of financial institutions, they continued on their merry way buying bonds and mortgage-backed securities alongside the Fed when they shouldn't have.
Well, to your point, I mean, I just saw this the other day. PIMCO, did you see this? They recently walked away from 10 hotels because they claimed that refinancing is too expensive. It's like, the biggest jingle mail situation, if to go back to 2008. And I say it like laughingly, but this is probably going to continue, right? I mean, people just walking away from these properties because they can't afford to pay the mortgage.
And what day did that happen? That happened on October the 2nd, when WeWork strategically defaulted on its first interest payments.
Oh, I didn't
When
know that.
PIMCO's like, okay, it's game over. We better have first mover advantage. So we're going to walk away.
Oh, so
And,
the first out the door rather than the last out the door.
exactly.
Yeah.
Exactly. And before that, Goldman Sachs put a price on its office properties in its commercial real estate holdings at 50 cents on the dollar. It's easy to be Goldman Sachs or PIMCO when you've got deep pockets and you can say, you know what, I'm going to take the mark. But that's why I cannot expressly answer your question about the fate of regional banks that don't necessarily have these deep pockets, because they don't have that same latitude.
Right.
They're dead men walking.
Well, I want to move on to to the bankruptcy issue, because you talked about WeWork already. Commercial real estate. I'm very concerned about regional banks, a lot due to your research that you've done and reading you. We have, you mentioned WeWork, PIMCO's walking away from commercial properties. Here's one that I did not expect to see, and you tell me how crazy this is. Burger King franchisees have declared bankruptcy. There are huge Burger King franchisees, 3 of them, that have probably about 400 Burger King franchises have filed for Chapter 11.
Yep.
They're citing wage and labor costs, the cost of borrowing, and supply chain issues that we thought would be done by now, since we're 3 years post pandemic. So what do you make of that? I mean, is that a sign of the times for retail as well?
Yeah, I think that supply chain issues aren't are a convenience factor at this point when it comes to pinning the blame. And I would even go so far as to say that we've had quite the replenishment of what had been a depleted pool of labor. So we've seen labor force participation increase, as well as some of the social safety net emergency measures that had been around because of the CARES Act. They were finally extinguished after the GOP took the House of Representatives. I'm talking about supplemental food benefits and supplemental Medicaid benefits that had existed up until very recently. What's a little less tenable is the real estate portion of it, and it's renewing those leases. So I could certainly see, and I saw the third one. I saw the third big, huge Burger King filing. I believe it was 163 locations, just that one. And it's quite remarkable to watch what's going on. But when you think about the CVS, the Walgreens, the Rite Aid alone, and that they're potentially anchors or close to a lot of these fast food restaurants. And when you think about the shrinking footprint of what had become very much overbuilt retail America, you can't blame a lot of these people for forcing in a restructuring process, being able to maintain their most profitable locations, right, and jettison the others. And what better way to do it? Again, I think that there's something to be said for strategic default in this kind of an environment. And you're going to see it more so headed into 2024, because the high yield maturity wall is coming. 2023 was a story about commercial real estate. 2024, 2025, that's when high yield and junk bond refinancing comes into play in a big way. And so you're talking about jingle mail to jingle bond. Ooh, I just came up with a new term. And whether or not restructuring is going to be a better way to refinance your debts when you're so far apart in terms of where you originally financed and where you can get current funding.
Well, the corporate bond story in 2024 is something I definitely want to talk to you about. I saw you write about that. While I was talking to Jim the other day, I figured I'd ask him, hey, Jim, I'm going to be talking to Danielle here in a little bit. What question would you ask Danielle? So if you don't mind, I'm going to channel my inner Jim Rickards and ask a question, if you don't mind.
Sure.
So Jim wants to know, is it possible the Fed is now far less relevant and powerful than it has been in the past decade? Are we at the point where policy tools such as rates and QE, QT are impotent in the face of a much more powerful factor, which is the economy itself? Have we arrived at the point where instead of the Fed steering the economy will now steer the Fed?
So I think to answer your question, Jim's question, that we will really know it when confidence in the Fed goes away. That's a Rubicon I doubt very, very few want to cross. Mm-hmm. Because that's what you're talking about. On a practical level, we forget that it took both fiscal and monetary easing after the pandemic hit to get what was a huge fire under control in the corporate bond market. We saw an explosion that overwhelmed what we saw in 07, 08, 09 in terms of fallen angels, investment grade debt that was downgraded to junk. I mean, just a huge spike in the number of these companies, revealing to you literally overnight in early 2020 how many of these companies really are, if in nothing but name only, junk bonds. So because timing is everything and starting points matter, even if there was to be a conflagration that broke out in the corporate debt market, the Federal Reserve, in my view, is not capable of single-handedly putting out the fire, because it required equal amounts of fiscal and monetary stimulus to put the last fire out. And again, I don't see this particular House of Representatives caring. Now, I say that as it looks like there's going to be some bipartisan going back and forth, but to do what? To buy time.
Yeah.
When it comes to actually delivering on something that's going to make heroes out of incumbents, that I don't see, at least until after the election. And at that point, I'll take Jim's theory one step further. If Donald Trump was to win, he spent more money than any of his predecessors in terms of giving money directly to the people. He wanted to give that second stimulus check. He wanted for it to be $2,000. He only got $600. So if it was to be a Donald Trump White House plus maybe a blue wave in Congress or a Democratic Senate and House of Representatives, and we were to get some massive wave of stimulus spending directly to the people, socialism, then you wouldn't even need a Fed. The Fed would become completely irrelevant. You could simply take interest rates back down to the zero bound, have the Federal Reserve monetize every penny, and have it assume some kind of an automated electronic function delivering money to the people. But you wouldn't need monetary policymakers. Monkeys can say interest rates are zero as far as the eye can see.
Yeah. Well, that's a very interesting take on that. And I didn't really think of going the guaranteed income path, but they're testing it out in different states. California's got some projects working out there or attempting to work. We'll see how those go. But
I mean, that's the buzziest name for the White House in 24 is Gavin Newsom.
Yep. Danielle, as we kind of get to the predictions for 2024, which I definitely want to hit you up for, I'd like to know this one thing. you're so deep into this space, and you do so much research, and you uncover so many things about the economy. What keeps you up at night when you're trying to go to sleep and something's nagging at you? What is that thing? Is it about the economy? Is it about the banking system? What is it? Or do you sleep? Do you sleep uninterrupted?
Oh, I wish I slept uninterrupted. What keeps me up at night the most is the societal impact. It's offering untold amounts of money to individual U.S. households, taking it away, the income divide, the idea of a deep and prolonged recession, and what it does to a society that's already frayed at the edges and on edge and looking for the enemy within. That's what keeps me up at night. It's the backlash in terms of our society for having been lower for longer, to the benefit of an increasingly tiny minority of the wealthiest. That's what really bothers me the very most, especially when you consider the theoretical solution that progressives would come up with, which would be giving people even more money, which would set us down a path to the Weimar Republic.
Yeah.
So that's what really, really keeps me up at night, is the idea of hyperinflation in America. Not hyperinflation in America because of Fed policy, but hyperinflation in America because of fiscal policy that's blindly monetized by the Fed in the way that was done in early 2020. That's what keeps me up at night.
And for good reason. All right, well, let's do this. I'd like to talk about what you see coming for 2024. And I want to specifically point you to talk specifically about the corporate bond market. I read something that you posted not too long ago on Twitter, and you called it the corporate bond story of 2024. And so maybe we could start there with your predictions or your outlook for 2024 as it pertains to corporate bonds.
So it's what I call Chapter 2.
Okay.
And Chapter 2 is as opposed to Chapter 1 was commercial real estate 2023. Chapter 2 is the corporate debt market 2024. So, again, as I was saying before, the word of the day is preemptively, and whether or not borrowers are going to preemptively look to restructure instead of refinance in 2024. So if you can afford the interest, the higher interest, then I think that you're going to preemptively refinance. If you cannot, I think you're going to preemptively restructure and file Chapter 11. But I think that what people are not expecting in 2024 is the sheer volume that we're going to be seeing. We're already seeing a run rate akin to that of 2010 in terms of bankruptcy filing, the pace at which we're seeing bankruptcies being filed. 2010 paled compared to 29. I'm afraid we're going backwards in time from 2010 to 2009, from 2023 to 2024. So I look to a situation in which the credit market itself becomes somewhat unhinged in 2024. So
in that scenario, what should investors do? What industry should they absolutely stay away from? And what industry should they flock to in order to protect their capital or find outsized gains?
So I think that that such an environment would also be deeply recessionary in nature. And because the employee retention credit and other forms of handing money directly to people, which I do not anticipate, again, until early 2025, I think you have to steer clear of companies that are solely profit engines as opposed to cash flow machines. Mm-hmm. So it's going to be the year of the balance sheet. And to the extent that companies can rein in what they're spending on share buybacks and focus on stalwart cash flows. And again, I think that a lot of the biggest tech companies are going to be recognized here in the next few years as being mere utilities, as opposed to innovators. And it's that transition from, this is seen as a proxy for fixed income or money good, to not going to survive a recession necessarily. And oh, by the way, IA might take it down type of thing. So I would be looking for true, strong balance sheet companies. And it's easy enough to see what populates, call it the triple C universe. And it's certainly not heavy cash flow type companies that do not rely on really tons of labor, because those are the ones I think we're going to see an epidemic of healthcare insolvencies in 2024.
That's interesting. Do you think that, let's talk about your outlook for banking, for the banking system, not just the regionals, but banks in general. Most of us on this channel have lived through 2008, and we're investors in 2008. And remember the time where, Bank of America went down to $6. I mean, it was just, even the big, well-capitalized banks ran into really strong headwinds. Do you see in that environment where corporate bonds are struggling, that the banking system comes under pressure, and we see an 08-ish type of a scenario?
So I don't think that too big to fail is going to be eradicated.
Okay.
In the sense that if the bank is too big to fail and it becomes very cheap, maybe you buy it. Maybe 2024 becomes the year of the big bank bargain. Hard to say, but no, I do not think that this Congress, even in an election year, is going to allow banks to fail. I think that it's simply a bridge too far. And certainly with our current Treasury Secretary, that would not be an option. Yeah. To allow to happen. That being said, we do have bank failures coming, and how banks are resolved, regional banks are resolved going forward, could potentially rewrite the regulatory history books again, because of the sheer amount of losses that are in play if there is a merger contemplated.
And yeah, I think it was Warren Buffett that came in and saved the day for Bank of America, right? He bought at around $6 or $7, and he got very favorable preferreds, I believe. And so there is a time to buy. It's just whether or not there is
a time to buy. But I would remind you that for 4 quarters in a row, he has grown his cash pile, and that speaks to one of the earlier observations that I made, that as an investor, you need to be very, very careful about listening to arguments about the price to earnings ratio being reasonable or being low if Mr. Buffett himself doesn't believe the narrative.
Right. Yeah, things can always get cheaper, can't they?
They can, before capitulation. And capitulation is something you recognize, and we have not seen it.
Well, Danielle, I would just like to thank you for a fantastic conversation. I'm really happy that you joined us. And for everyone watching, you can get access to Danielle's social media. Like I said, she is a great Twitter follow. And you can get access to QI Intelligence and her book, Fed Up. All of those will be linked in the description below for you to check out. Danielle, thanks again for being with us again. And I hope to see you soon. And have a great Thanksgiving.
Likewise. Happy Thanksgiving to you and yours. Great talking to you today.
All right. Take care.